Hello financial fans, welcome back to another stock analysis. Today we'll be covering Amazon stock ticker AMZN. Amazon is a multinational e-commerce and cloud computing company. They sell a wide range of products online, including books, electronics, and clothing, as well as offering a variety of delivery options. Additionally, they provide cloud computing infrastructure and services to businesses through Amazon Web Services, or AWS. Amazon has also expanded into digital streaming with Twitch and smart home technology and physical stores such as Amazon Go and Amazon Books. They are currently sitting at a market cap of $979 billion, and in 2022 they generated a revenue of $513 billion. 47.3% of their revenue comes from online stores, 22% from third-party selling, 13.2% from Amazon Web Services, 6.8% from Amazon Prime, 6.6% from advertising, 3.6% from physical stores, and the remaining 0.5% for other various income streams. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 20%. That can never be below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from a margin of safety. First two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT of Amazon has gone down over the years with a massive run up to 2021, but in 2022 they were actually EBIT negative. But it has gone from almost 600 million in 2015 to negative 2.7 billion in 2022. The average growth rate is still 30.5%, seeing as it had the massive run up into 2021, which is a 10% deduction in the margin of safety. The margin has also gone up in the similar way as the EBIT has gone, going from 0.5% in 2015 to 7.1% in 2021, but coming down to minus 0.53% in 2022. The average EBIT, or margin growth rather, has still been 17%, which is another 5% deduction for a margin of safety. The final two ratios that we're going to look at are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For Amazon, this is almost 2 years, in this case, a 183% debt to EBITDA ratio, which is no change in the margin of safety. Amazon also has a return on invested capital ratio of 1.9%, which is no change in the margin of safety once again. Let's go look at the valuation models next to determine the intrinsic value of Amazon. The first valuation model that we'll be using is the discounted cash flow model. I've imported free cash flow of Amazon going from 2013 to 2022. The average growth rate in free cash flow annually during this period was 42.5%, and I'm projecting an expected growth rate of 25% in their free cash flow annually. We have seen that in 2021 and 2022 they have become cash flow negative. I'm expecting this to continue into 2022 and 2023, but I'm expecting that in 2024 they will be cash flow positive again. And going forward in these years, I'm expecting that's 25% growth. I will also determine a terminal year valuation for Amazon using a perpetual growth rate of 3% and a discount rate of 8%. This gives us a sum of free cash flow of $823.3 billion. And to get our equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $753.2 billion. All we have to do then to get our intrinsic value out of this model is to divide it by the amount of shares outstanding, giving us a discounted cash flow price per share of $73.49, which is almost a 23% downside out of this model. The second model that we'll be using is the Graham's revised valuation formula. In this model, we look at the forward earnings per share of Amazon, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. And we go by the theory that a company with no growth is always sitting at a PE of 7. Taking a look at all of these metrics, we get a fair value of $75.20, which is a 21.18% downside out of this model. Since a lot of models that we use on this channel are not compatible with Amazon currently, these two models are the only ones that we'll be using this time. And if you want access to all of the models I use on this channel, including the ones that we've just shown, you can check in the description for my Patreon link. Let's go look at the final overview of our valuation next. Looking at our final overview, we've imported discounted cash flow and Graham's valuation price per share, giving us an average of $74.34. On margin of safety, we've determined earlier using a standard margin of safety of 20%, deducting it by 10% for the EBIT growth and 5% for the margin growth, leaving us with a 5% margin of safety. Applying this margin of safety, we get a fair value of $70.63. And with the current price of $95.41, we get a downside of almost 26%, indicating that it's currently a sell, or that I would rather buy it at $70.63. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.